Welcome to Index Orbit. In this analysis, we are evaluating the Poojaa Precision Engineering IPO using the disclosures, financial numbers, subscription data, and the reported gray market signals supplied in the source material. We will not treat any single headline as a conclusion. Instead, we will move through a simple investment pipeline. First, understand the business, then check growth and cash needs, compare the valuation with peers, inspect the use of funds and ownership, and finally, balance strengths against risks. Poojaa is a Pune-based precision engineering company making aluminium die-cast and machined components for automotive, electric vehicle, agriculture, defense, energy, and healthcare customers. It reports 2 facilities, melting capacity of 13,800 metric tons, casting and finishing capacity of 6,000 metric tons, more than 600 SKUs, and 58 customers. The IPO price band is 285 to 301 rupees. The stated lot size is 400 shares. The issue size is 159.83 crore rupees. And the issue is on the BSE SME platform. If you want to learn option trading, there is a playlist available on my channel. Now let us test whether this IPO is attractive only for a listing pop or also suitable for a longer-term investment. Before discussing whether the IPO is good, we need to know exactly what an investor is being asked to buy. The supplied document gives a price band from 285 rupees to 301 rupees and a lot size of 400 shares. At the upper price, the arithmetic is straightforward. 301 rupees multiplied by 400 shares equals 120,400 rupees. At the lower price, 285 multiplied by 400 equals 114,000 rupees. So, based on those two inputs, one 400-share lot requires between 114,000 and 120,400 rupees before any applicable charges. But the same document also states a minimum investment of 228,000 rupees. That number does not match a 400-share lot. 800 shares multiplied by 285 equals 228,000, while 800 shares multiplied by 301 equals 240,800. This is an important quality control point, not a minor detail. The final lot size and application amount should be checked in the official exchange notice and broker application screen. The issue dates are stated as 28 to 30th July 2026, with an estimated listing on 4th August 2026. Because this is an SME IPO, liquidity, trading access, price bands, and volatility can differ materially from a main board IPO. Let us start with the financial engine. Operating revenue increased from 173 rupees and 72 paise crore in financial year 2024 to 222 rupees crore in financial year 2025, and 293 rupees and 86 paise crore in financial year 2026. The total increase from 2024 to 2026 is 120 rupees and 14 paise crore, which is 69.15%. Spread over 2 years, the compound annual growth rate is approximately 30.10%. So the source's roughly 30% figure checks out. Net profit is available for only the last 2 years in the supplied table. 23 rupees and 93 paises crore in financial year 2025 and 30 rupees and 90 paises crore in financial year 2026. That is a year-on-year increase of 6 rupees and 97 paise crore, or approximately 29.13%. We cannot verify a 2-year profit CAGR because financial year 2024 profit is shown as unavailable. In financial year 2026, profit divided by total income gives a margin of 30 rupees and 90 paises divided by 295 rupees and 20 paises, or approximately 10.47%. The balance sheet also grew. Equity rose from 86 rupees and 20 paise crore to 133 rupees and 16 paise crore, and assets rose from 135 rupees and 92 paise crore to 231 rupees and 38 paise crore between financial years 2025 and 2026. The concern is funding. Borrowings stood at 70 rupees and 83 paise crore as of the 30th of June 2026, while investing cash flow was negative 57 rupees and 35 paise krom in financial year 2026. Growth is visible, but expansion is demanding cash and increases financial risk. A low price is not automatically a low valuation, so we compare the issue with earnings and peers. At the upper price band cap of 301 rupees, the supplied fiscal year 2026 basic earnings per share is 21.90 rupees. The PE calculation is 301 rupees divided by 21.90 rupees, which equals approximately 13.74 times, or about 13.7 times. That is below the stated industry average PE of 35.77 times. The listed peer figures are also higher. Alicon Castalloy is shown at 31.49 times, RICO Auto Industries at 36.29 times, and Endurance Technologies at 39.52 times. The comparison looks attractive on paper, but we should understand what it does and does not prove. It does show that the IPO price is low relative to the supplied fiscal year 2026 earnings and the selected peer multiples. It does not guarantee that earnings will continue, that the peer businesses are perfectly comparable, or that an SME stock will trade with the same liquidity as a listed larger company. Return on net worth is another positive data point. Poojaa is shown at 23.21% in fiscal year 2026, with a 3-year weighted average of 25%, versus peer figures from 5.48% to 13.91%. Book value per share also rose from 47.36 rupees to 94.36 rupees. Valuation is therefore a strength, but the quality and durability of future earnings remain the key question. Next, we examine who controls the company and at what historical cost. Promoters and the promoter group are reported to hold 82.63% before the issue and 60.63% after the issue. The reduction is 22 percentage points, representing dilution from the fresh public offering structure described in the source. The document also reports promoter acquisition costs ranging from 4.87 rupees to 7.13 rupees per share, compared with the IPO band of 285 to 301 rupees. At the lower comparison, 285 rupees divided by 7.13 is approximately 40 times. At the upper comparison, 301 rupees divided by 4.87 is approximately 61.8 times. That is why the source describes the difference as roughly a 40 to 60 times markup. This does not, by itself, prove wrongdoing. Historical shares may have been issued at low face values, and large cost differences are common in some SME IPOs. But it does tell us that promoters are diluting or selling part of an ownership position at a very large gain relative to their recorded entry cost. Investors should ask whether the post-issue ownership remains sufficiently aligned, whether there are lock-in requirements, and whether the public shareholding will support healthy trading liquidity. The use of IPO proceeds tells us what management intends to do with the capital. The largest stated use is a new manufacturing facility at KED, Pune. The disclosed amount is 10,633.59 lakh rupees, or approximately 106.34 crore rupees, for capital expenditure. Working capital requirements are listed at 3,000 lakh rupees, or 30 crore rupees. If we add those two disclosed amounts, we get 13,633.59 lakh rupees. The capital expenditure share is 10,633.59 lakh rupees divided by 13,633.59 lakh rupees, which is approximately 77.99%. The working capital share is approximately 22.01%. These calculations support the source's roughly 78% and 22% split, before adjusting for issue expenses and any general corporate purpose amount. The positive interpretation is that the money is primarily directed toward growth capacity rather than a straightforward promoter exit or debt repayment. The negative interpretation is execution risk. A new facility, a magnesium casting line, equipment installation, customer qualification, and production ramp-up can all be delayed or cost more than expected. The source also says the expansion has not been appraised by a bank or financial institution. so the proceeds are growth-oriented. But investors are being asked to fund a plan whose future returns are not yet proven. Now let us separate the company's current operating strengths from its future expansion promises. The company reports 2 Pune manufacturing facilities with melting capacity of 13,800 metric tons and casting capacity of 6,000 metric tons. Reported utilization is about 80% and 84% respectively in financial year 2026, suggesting that existing assets are already being used meaningfully. The business also has an in-house design and engineering team of 17 engineers supporting reverse engineering and ISO certifications. Customer count increased from 39 in financial year 2024 to 58 in financial year 2026, while the company supplies more than 600 SKUs across automotive, electric vehicle, and non-automotive segments. Management experience is another stated strength. The source lists Anil Kulkarni with 32 years, Rahul Ranka with 25 years, and Sanket Kulkarni with 16 years of precision engineering experience. Finally, the reported growth profile is encouraging. Revenue grew at approximately 30% over the stated period, and profit grew faster from the available financial year 2025 to financial year 2026 comparison. These points suggest technical capability, customer breadth, and operating momentum. But they are evidence of the current platform, not proof that the new facility will immediately produce the same returns. A balanced IPO analysis must give the risks as much attention as the strengths. First is customer concentration. The top 5 customers contribute more than 70% of revenue, and the largest customer alone contributed 31.75% in financial year 2026. The source says there are no long-term contracts, so purchase orders may be canceled unilaterally. Second is raw material exposure. Aluminium accounts for 72.43% of raw material consumed, and the company reportedly lacks firm price supplier contracts. If aluminium prices rise faster than selling prices, margins can compress. Third is sector concentration. Approximately 72.58% of financial year 2026 revenue came from automotive, leaving the business exposed to changes in vehicle demand, regulation, and the electric vehicle transition. Manufacturing also brings environmental, health, safety, fire, explosion, and hazardous material risks. Then there is the untested expansion into a new Pune facility and magnesium casting with delay, cost overrun, ramp-up, and customer acceptance risks. Borrowings of 70.83 crore rupees add financial pressure, especially where cash credit facilities may be repayable on demand. The source also flags gaps in historical corporate records, including certain filings, while the reported litigation appears minor: a 7.33 lakh rupee tax matter and a 7.46 lakh rupee civil dispute. Each risk may be manageable alone, but together they reduce the margin of safety. Demand data can influence listing expectations, but it should not replace fundamental analysis. The supplied subscription table shows retail at 12.69 times, small HNI at 11.26 times, big HNI at 8.98 times, qualified institutional buyers at 0.17 times, employees at 0.37 times, and overall subscription at 8.38 times. The pattern is clear. Retail and non-institutional demand is strong, while QIB participation is very weak. That combination can support a dramatic listing day move, but it may also indicate limited institutional conviction and a thin, volatile trading environment. We must also be precise about the gray market numbers. The source says GMP rose from 150 rupees on 23rd July to 260 rupees on 28th July, and separately describes an approximately 86% premium over the 301 rupee cap price. If we calculate the quoted 260 rupees against 301 rupees, the result is not a positive 86% premium. It is 260 rupees minus 301 rupees divided by 301 rupees, which equals negative 13.62%. To imply an 86% premium, the listing price would need to be approximately 560 rupees, because 301 rupees multiplied by 1.86 equals 559.86. This may reflect a different GMP convention or a transcription error, but it cannot be treated as verified. Therefore, subscription is a real reported demand indicator, while GMP is unofficial and should be independently checked before making an application decision. Here is the conclusion, separated into two different decisions. For a listing gain application, the case is relatively favorable for an investor who understands SME risk. The supplied numbers show a cap price PE of approximately 13.7 times against a stated industry average of 35.7 times and peer multiples from about 31.49 to 39.52 times. Return on net worth is reported at 23.21%. Subscription is 8.38 times overall. And retail and HNI demand is strong. These are supportive signals, but the gray market premium is unofficial and internally inconsistent in the supplied material, so it should not be used as guaranteed profit. The recommendation for this narrow objective is subscribe primarily for listing gains only if the investor can tolerate lower liquidity, larger price bands, and sharp volatility. For a long-term hold, the recommendation is more cautious. The company has good reported growth, meaningful current utilization, a growing customer count, and an attractive relative valuation. Against that, nearly 78% of the disclosed proceeds go to a new facility. Expansion is not yet proven. Borrowings are 70.83 crore rupees. Customer concentration is high. Aluminium and automotive exposure are substantial. QIB subscription is only 0.17 times, and historical record gaps require attention. A sensible long-term approach is to wait and monitor 2 to 3 post-listing quarters. Facility ramp-up, margins, debt, customer concentration, cash flow, and evidence of new customer qualification. My final view is therefore, subscribe primarily for listing gains. Be cautious about holding for the long term. This is educational analysis, not personalized investment advice. Please read the full DRHP and consult a SEBI-registered advisor. Let us recap the complete investment picture. Poojaa Precision Engineering operates in a growing precision components market and reports strong revenue growth, improving profit, current facility utilization, engineering capability, and a valuation that looks inexpensive against the supplied peers. The IPO proceeds are mainly for growth capex, which can create future capacity but also creates execution risk. Promoter ownership falls from 82.63% to 60.63%, while the very large gap between historical acquisition cost and IPO price deserves awareness. The main risks are concentrated customers, aluminium exposure, automotive dependence, borrowings of 70.83 crore rupees, an untested facility and magnesium line, weak QIB participation, and SME market liquidity. The arithmetic also found 2 data issues that must be checked. The stated 228,000 rupee minimum investment does not match a 400-share lot, and the 260 rupee GMP does not mathematically equal an 86% premium over 301 rupees. So the final framework is simple. Consider the IPO selectively for a listing gain objective if you understand the risks, but wait for 2 to 3 quarters of execution evidence before considering a long-term holding. Subscribe to Index Orbit for more analysis, and if you want to learn option trading, there is a playlist available on my channel. Always verify the official documents before investing.